Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, July 23rd, 2023. We've got another great program for you this week as members of the media, academia, financial services, and government are standing by as we break down all the key news and events for the week. You're not going to want to miss it, but you are going to want to sit back, relax, and enjoy this episode of BRN Sunday. Where we're going to kick off the week, as we always do, with a look at what's happening on Capitol Hill in terms of legislation, regulation, mediation, arbitration, and so much more. Joining us on the line, that you know them as the Legal Eagles, but they're also known as David Levine, Kevin Walsh. Both are principals with Groom Law Group, and that's an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for stopping by the program this morning.
It's great to be here with the nation that is Broadcaster Retirement Nation.
That's right. That's a pickup of what we talked about last week. Always
Exactly.
great to talk to you, gentlemen. Kevin, I want to. We're going to do a kind of a grab bag today because there's so much going on in the retirement and benefits industry. Let's talk about the labor secretary. Why don't you kick us off on that one, Julie Sue?
Yeah. So, I mean, as folks remember, Marty Walsh was President Biden's first labor secretary. He stepped down in March of this year, and President Biden nominated the assistant secretary, Julie Sue, to serve as the next Secretary of Labor. Since that time, we've been waiting for the Senate to vote on her confirmation. With the Senate divided, 51-49, acting Secretary Sue can only afford to lose one vote and be confirmed. In the last week, the White House has made clear that, at least for now, Senators Manchin and Sinema will not vote for her confirmation. That puts her in a position where, if there were a vote, she'd have 49 votes in support and 51 votes against, and that would not be a successful confirmation vote. What's going on as a result is there's a little bit of limbo where, depending on how you interpret the statutes governing federal vacancies, either she can serve indefinitely as the acting secretary under a reading of a DOL statute, or by November, they're going to need to find somebody else to put up for the job under the Federal Vacancies Reform Act. So there's some tension over the statutes. There's some time between here and there where she could potentially, sway one of the two holdout senators or sway a Republican senator. But for now, it looks as though her confirmation, that there will not be a vote on her confirmation for the foreseeable future. And that puts the Labor Department in kind of a tenuous position, because if it turns out that she's not eligible to be in that position after a certain amount of time, then it creates some risk for agency action that happens after that date.
Yeah, and thanks for that, Kevin. And David, I want to pivot to you because I want to pick up on that conversation, but I know there have been, we've got secure regulations, we've got other regulations going on. What does this mean? Does it mean anything when it comes to secure? And I know there was a request this week to delay the implementation, I think, of the Roth catch-up contribution, which is part of Secure 2.0 or 2.0.
Sure. Well, definitely. As you know, we do with this before every election with you, Kevin. Kevin and I do this. Sorry, Jeff. We always talk about, well, what are we going to do? Like, what's the timeline to get regulations out? We're probably due for that discussion because the clock is starting to run on the Biden administration. But as Kevin noted, it does raise some real questions, and there's a lot more we'll be talking about. Let's pivot, though, into the required Roth catch-ups. Quick refresh. The idea is that if you earned over $145,000 in the prior year in Social Security wages, FICA wages, you have to, your catch-up contributions in 2024, if you do that in 2023, will have to be on a Roth after-tax basis. there's a lot of challenges in making this work and systematically and getting all the pieces. And there are still decent chunks of the retirement system in the defined contribution world that don't have Roth. So adding Roth is a big deal for a number of these folks, especially governmental entities. As a result, there is a industry-wide coalition that has submitted many letters to the IRS, to Congress, had meetings all over. We've been really active with some of the trades we represent and individual clients on this exact topic. Now, so where are we at this point? As of right now, the requirement that contributions for these people be Roth in 2024, it stands. We don't have IRS guidance yet. There's sort of two paths that are out there. That is, one, maybe Congress will delay it, but the greatest challenge is we still need to fund the government. And if they're looking for the bipartisan moment, this is a great thing to stick in. But we'll have to see, because Roth is a revenue generator. So if there's a concern about budget deficits, it could get slowed down because it raises money for the budget. On the other hand, if not, it could easily get fixed. But a lot of people are moving forward right now. So my takeaways for plan sponsors are, and unfortunately, you should be figuring out your systems and processes, working with your vendors. If you're not ready, just hope for the best, but also hope that the IRS gives some type of transition relief. That's the second part. The IRS just in the past week or so has given us guidance on the age 72, age 73, age 70 and a half required minimum distribution rules, which gave some more transition relief, which allowed people to catch up after doing it, well, with what the IRS would say would be inconsistent with where the guidance is going. We can all debate that, but the fact is the IRS is giving people transition relief. And I would not be surprised if we see something like that from the IRS next year. Maybe something along the lines of, if you can't get Roth up and running, as long as you track it, and by the end of 2024, ideally 2025, you can, for any money that's still in the plan, you properly allocate it to Roth buckets, great. We'll have to see where we land. But that is that at this point. But I know, Jeff, there's a lot of other things going on. There's other guidance in the pipeline. So I'm happy to throw to you or to Mr. Walsh.
Let's go to Mr. Walsh, Kevin. I know we're kind of bumping up against the end of the segment, but I wouldn't be remiss if I didn't ask you about some other regs, some other guidance. What we're, I think there's some stuff at the OMB, the Office of Management and Budget that you wanted to talk about.
There is, and we're coming up on deadlines essentially if the administration wants to finalize rules. And so there's two things over there now. There is an interim final rule related to abandoned plans that we expect to see out in the next month and a half. And also they have an RFI, a request for information, which is a pre-rulemaking stage on how to modernize plan disclosures in light of Secure 2.0. So we know the Labor Department's very active in response to all the Secure 2.0 deadlines. And now they're racing the clock, not just with the presidential, with the secure deadlines, with the possible presidential change, and also with respect to deadlines for their acting secretary to continue serving as acting secretary. It's a bit of a race right now over at DOL.
Yeah, sounds like they're going to be busy. We talked with both of you gentlemen who at the beginning of the summer told us this is not a time for letdown. This is a time for heating up. It looks like the heat is turning up in terms of getting those regs out. Lots of work going on in that Department of Labor. Gentlemen, we're going to leave it there. Always great to talk to you. Thanks for showing us a little bit of the inside baseball and also giving us some explanations that we need to help break it all down and understand it. Have a great week, and we'll talk to you again next week.
Thanks for being on, Jeff. And thank you, listeners.
Bye, gentlemen. Have a great weekend.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions, and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Now it's time to break down markets for the week, and joining us on the line, he's the lead anchor for the TD Ameritrade Network, talking about Mr. Oliver Renick. Oliver, welcome back to the program. So great to have you on this morning.
Thank you, Jeff. Always appreciate it.
Yep, and you have your nose to the grindstone when it comes to understanding markets. Let's talk about this market just in general. We've got the Fed meeting coming up. I know there's some conversations happening about raising rates maybe for the last time for the year. We don't know. Mm-hmm. But what's your assessment of this market? I mean, investors seem to be bullish, or at least some do, some aren't. How do you take stock of this economy, pun intended?
Yeah, it's pretty still confusing economy. Generally, the sort of baseline we should start with is that the most important thing about the economy is that it's been better than expectations. That is the most important kind of base level thing. Economic data has been more resilient, especially in the jobs market, of course, and inflation has come down even a little bit quicker than folks maybe had expected for the last few readings. And so all of that has been a very important macroeconomic backdrop for the stock market to firm up, rally, get back into gear, and also a separate story about a burgeoning tech breakthrough in artificial intelligence and what that means for companies that are going to be creating products and services based off this, and chip makers are going to sell all the technology to run these robotic algos and stuff. And so you've got these kind of two-pronged, really bullish cocktail where it's like the first major technological breakthrough we've really had in quite some time that's like actually already creating products and services, and kind of the first major thematic breakthrough for the stock market since COVID, maybe even a little bit before COVID too. So it's given us a lot of things to think about other than last year's inflation plague and then the prior year's just very murky post-COVID environment. And then, of course, prior to that, COVID itself. So everything has been better than expectations. From both the macro and the micro, and it might get a little bit more complicated going forward.
Sorry, I didn't mean to interrupt you on that, Oliver.
No,
so as you look out into next week, and you know, it's complicated because it's not there. It's so many mixed signals. And if you're Jerome Powell, and it just seems like the market has really baked in this,
yes,
hey, this is going to happen, right? So if you're Jerome Powell and the Board of Governors, the Fed governors, I mean, you almost have to raise rates. So in order to placate the market, if not, you're going to reverse all the expectations?
Well, it's really an interesting spot because the way you frame it, a lot of people don't really frame it, but I think it's actually a good way to think about it, the way you frame it there, which is to placate the market wanting a hike. The Fed generally is just Powell's Fed in particular, but really every Fed that we've known in this generation. It just does what the market does, basically. So if the market's pricing in a hike, they hike. If the market's pricing in a cut, they cut. Beyond the next immediate event, there is sometimes a disagreement, oftentimes disagreement between the market and the Fed. But to your point, a week out, when the market says hike, he's going to hike. Now, by his own standards of what he's told us he's watching, he probably never should have paused to begin with, because we haven't met the criteria, which technically he has said we have to meet for them to stop hiking, which is inflation at 2%, more unemployment, and all that. But things changed very dramatically earlier this year when regional banks in the West Coast went bankrupt, and there was a big fear about contagion across the financial system. It still is probably the most important event of the year. And it's really important to keep that in focus right now, because that changed everything.
Mm-hmm.
Back in March when that happened, the whole outlook for the economy soured, and very dramatically. It was expectations fell off a cliff, basically. And so because of that, it started pricing in rate cuts instead of rate hikes. It started assuming that disinflation was the result of an imminent, very deep rollover in the economy. Mm-hmm. Not even really like recession. Like the fear was that there was going to be a massive financial-driven economic event. And so our entire framework for the year changed. That was 4 months ago. The stocks had already been rallying going into that because inflation was cooling off and because just the market had been down really bad last year, and we were kind of in the middle of this relief rally. But March and April, everything really, really took a turn in the world of expectations. And so since then, we've been able to beat all those expectations. Now, the catch, of course, is that Powell also dramatically changed his own outlook around the regional banks. And every time he's spoken about pausing and waiting to see effects of their policy from last year, he's always cited the regional banks. And basically what we learned this quarter is that there is very unlikely to be any major collapse imminent, like not even close, more just like so many other companies that over the last 18 months proved that they couldn't really handle higher rates. That's what a few of these banks did. And everything seems fine on that front. So that's definitely going to complicate the message for the economy going forward when we hear from Powell next week.
I want to ask you the last question about tech earnings, and you mentioned artificial intelligence. It seems like just yesterday you and I were talking about Chat GPT and how that was going to, I guess, replace everybody and the news anchors, and we were all going to sit on the sidelines playing chess, poker, whatever. What do you think about, and it wasn't too long ago, by the way, Oliver, that we were talking about tech layoffs, and maybe they're still happening to some extent. A lot of jobs lost in that industry. What does this mean? Are we expecting to see earnings really continue and to thrive for these technology companies here? You know, we've already talked about NVIDIA, but Meta, Apple, I mean, you name it. And even the financial services companies now getting into the game. The healthcare companies getting into the game. Oh yeah, we've got AI now. You're going to be all healed.
Yeah, it's so far been very hardware focused, and now we're really going to see on the software and services side of the technology sector what products are they actually making based off this. So we know from NVIDIA last quarter that there's already a big demand for the hardware and the semiconductors that these companies are going to use to power these really strong AI models that require a lot of hardware and computing power. So they already bought all the materials, basically. Now the question is, are they actually going to make a product with it that sells and changes the way we do business and live? And that is very much still to be determined. The first one we'll be able to kind of gauge is Microsoft's Office Copilot, how big of a game changer that is. It seems like it could be really helpful in a lot of ways. So this is definitely going to help earnings for a handful of companies and some really important ones. But then it's also not really going to change anything for some other companies that are AI related. I mean, like Tesla is probably the most advanced AI company that we talk about on a regular basis, and this is not really going to change their stock going forward. As we learned this week, it's about profit, cash flow, how many cars you sell, and at what cost. And even though there's a big AI potential for them, this is going to be something that so far is very important for a handful of companies, likely will broaden out over time, but a lot of that is still to be determined. And stock market's had a very, very, very big rally that, in the context still of a high inflation environment, is very surprising on many fronts. So it is now having a lot to live up to. Next week's going to be really important. If you can get some of these companies to continue rallying and show that they really have a positive effect on the bottom line, and that's a big deal. It's very bullish.
Yeah. Well, we're going to have to check in again next week with you. He's Oliver Renick.
Sure.
He's the lead anchor of the TD Ameritrade Network. You can definitely check him out. He is the lead anchor on two shows, Morning Trade Live and Markets on the Close. Did I have that right?
You got it right.
Okay, I got it right. Oliver Renick, great to talk to you. Enjoy the rest of your weekend, my friend, and we'll talk to you again next week. Bye-bye. Bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN. We'll have a very special guest. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.